Hello, everybody. We're back and in studio today. Dylan Radigan, how are you? We're live for Truth or Skepticism. It's Wednesday, October 11th at just after 1 o'clock Central Time.
Listen, it's become a rare privilege to see you in human form. I was also there's been sort of many stories about your back, which I feel like that maybe they're there's hyperbolic. You seem to be in fine form. And so I'm happy to see you.
Fine form is a little bit stretching it, but yes, we're alive and well.
You're standing up and sitting down in a civilized manner.
Stories of my demise are a little premature.
That's all I'm here to say. The stories of your demise are indeed premature.
The puts have, I'm sorry, the calls have not expired worthless yet.
No. And in fact, there was a concern that the contract was coming in earlier, but I think you got lots of time. Lots of time.
Yeah, so we're good. And thanks for coming out to Chicago today. I know you've got a ton of stuff to do. You've been filming all day, which is great, and we're looking forward to it. But we've got
and I've been hanging out with the Overtime Boys after the bell every day, which has been fun with Chris Vecchio and Ilya.
Yeah.
So thank you for giving me the opportunity to chat with them. It hasn't exactly helped my investment account, but I'm enjoying it all the same.
Yeah,
I'm doing the opposite of them.
They're two macro boys, and the thing with the macro guys, I love listening to them because then I just do the opposite. But just like anybody else, I do it with anybody. But I haven't had a lot of success in changing them.
In terms of influencing them towards towards your methodology. But how long have they been around?
Well, they've only been they've been in the tasty world for less than a year, but they've been with the firm for a long time. But they were in a different capacity, working in the FX side. But on the tasty side, it's been less than a year. But they're stubborn, and they're set in their ways. They're a little stubborn, so it's been a challenge to get them to cross over. But through a lot of there's a lot of.
I'm like your sleeper agent. I was once your greatest adversary, and now I've become your prime your sleeper cell to convert them gently.
Yeah, exactly. We're counting on you, and so
inserted me into the theater.
We're definitely counting on you to make a difference. But for purposes of Truth or Skepticism, let's get back to business today because we haven't had a chance to do stuff in the studio.
So then let's just talk about the elephant in the room because I haven't seen you for a week.
Agreed.
There's been a substantial amount of information that has occurred, that is information about things that have occurred that are some of the most alarming, horrifying, heartbreaking.
Yeah.
I mean, some of the worst news of our adult lifetimes.
Yeah. It doesn't get any
terrorist attacks, all this. And 1 week on, the market is at best indifferent and perhaps even mildly improved.
Yeah, I would say
there's a
higher.
And so, how do you interpret that? Between the choice being economic irrelevance, doesn't matter. Human tragedy, economically irrelevant. Or economically relevant, but priced in, that the market is, that you cannot shock this market.
I'm not sure if the economics part of it is that important to me. I think in an era where everything is live streamed essentially, like I still in my mind have these kind of not visions, but these visuals of things going back as far as kind of like civil rights movements and Vietnam War scenes and just horrible situations with civilians and
human catastrophe.
Human catastrophe. That's the word. Human catastrophe. And you have this. You have all this stuff that goes through your head where you have these visions that have stuck with you for decades and stuff. And now with the world live streaming everything, it's magnified 100 times, 1,000 times. And so the visuals that we're going to have that are going to stick with us and what's going on right now is just, it's going to last forever. But the crazy thing about the stock market, and this is the most important thing, is the reason that a lot of people don't invest themselves, a lot of people don't manage their own money, they don't invest, is because they're worried about risk, right? It's all about risk. Everything's about risk.
Risk avoidance. They don't feel comfortable. There's a risk of. I talked about this earlier, but right.
Anyway, everything's everything's about risk avoidance.
Risk avoidance or actually risk sort of mismanagement, which I'm prone to.
There's only two reasons why everybody in the world is not a tasty trader, in my mind. One is because, you have three reasons. Not enough money, not enough resources, meaning time-wise, not enough disposable money, not enough resources to just the time to do it. And the third one, which is the one that comes to us the most, is hey, I'm just not comfortable with the risk. And I'm like, I'm not sure what that exactly means, because we've 100 ways from, we've broken down risk 100 different ways on stock versus leverage products, stock versus options, stock versus futures, option strategies versus stock strategies, all this kind of stuff. But I think the concept of this unquantifiable, undefined risk, not undefined risk in the sense you sell a call, the stock goes higher, that kind of thing. Unquantifiable risk, like what happens if, when genius fails? What happens when one day we wake up and it's a 9/11 again, or it's a something. I can't put it into. I don't know what it is because we don't know yet. So then you have to start thinking back at all the different times throughout the last 3, 4, 5 decades, and you have to start thinking, okay, like what are some of those times? Like what is that? 9/11? Okay, great. We'll give that. That was the first time we've seen kind of a domestic terrorist attack on
and the camera people jumping out of the sort of the worst possible.
The worst. But the first time we've seen it on our soil, that kind of thing. So it hit home. And then you fast forward. So that's 2001. So you fast forward 20 years to 2020, and you have this thing called a pandemic. And in the pandemic, again, nobody knew what that meant, or nobody really understood it. So all of a sudden you have this 35 days. It took 35 days to normalize. The 9/11 took a little, probably, a little bit longer, but same thing, about 35 days to normalize. All of a sudden you have this horrific situation over the past weekend in the Middle East, and you're thinking to yourself, okay, what does this mean? How could it possibly normalize in 12 hours between Sunday night and Monday morning? Literally normalize in 12 hours.
We all watched it.
So then what does that mean about unquantifiable risk? Like, how much risk is there really such a thing anymore as risk that you can't quantify? Is there really, we know there's situations where occasionally they'll get a 3, 4, or a 5 standard deviation move, things like that, or a 7 standard deviation move. But the reality is, that's unquantifiable risk. Is that really something that anybody? What's the difference between that and walking outside and, and getting hit by a stray bullet or lightning or whatever else it is? It's a ridiculous.
Or then you have to price it all at zero, so it becomes irrelevant.
It really is irrelevant.
You have to price lightning at zero.
Yeah, you have to price. Of course, you price lightning at zero. You price slipping in the shower at zero. You price lightning at zero. You price stray random
attack,
things.
Zero.
Shark attack zero. Exactly. Your building collapse. You have to price.
But even when I would argue like this weekend is the equivalent of a shark attack times a billion, right? It's like
of course,
and the market's still indifferent.
So what I'm saying is that, but for a gazillion years, the whole thing was, get rid of this outlier risk, and I will do things differently.
Meaning from a prospective customer perspective.
Yeah. So essentially, what we're saying now is, I don't know if there is unquantifiable risk anymore. Like, I don't know. Based on what I've seen in the last 20 or 30 years,
whether it's 9/11, you're using 9/11, the pandemic, and this weekend as the three,
or whatever, pick whatever you want,
so you're left with. So what it reminds me of, because I was a reporter for Bloomberg, at September 11th, and September 11th obviously had happened in the fall, and then there was Warren Buffett's annual meeting, in May of the whatever that is, 7 or 8 months later. And I was at the annual meeting interviewing him. And my perspective in interviewing him was that not so much of, whatever, world's richest man or world's biggest stock picker, but insurance CEO. A new risk.
There you go.
September 11th, this guy has a bunch of insurance, or at least reinsurance, or sort of derivative insurance exposure. More interesting to interview him through the perspective of risk assessment, with the obvious thing being, and he basically said, you have to assume that I remember what provoked the question, that you have to assume the probability of an NCB attack in the next 100 years has to be very high. And an NCB attack is nuclear, chemical, and biological. And this was, 20 years ago.
Okay.
And at the same time, he was like, the probability something like that happens in the next 100 years, very high. The probability that I know when, where, or how that happens, 0. And so I price new NCB risk at 0. Which is basically what we're saying here now.
Exactly.
But now, even in the event of, not that this is a nuclear, chemical, or biological, but I would argue whether it's 9/11 or what happened this weekend, it is of the same level of horror.
Yeah.
If it's, the nature of the weapon is less relevant than the catastrophic nature of the behavior and the weaponry's effectiveness. And we're getting the equivalent of a nuclear, chemical, biological. By the way, pandemic is a biological, right? Even if it's naturally occurring or however it came to be. I find it almost inexplicable that the market is indifferent to it, but for the fact that it's a testament to the resilience of the economy.
I think 20 years ago, or 30 years ago, I would have found it inexplicable. I think today, I think today it actually is very easy to explain and accept. I think it's very possible that we've been mispricing just for reasons that because people they're still not believers, they just haven't come across to the other side, that we've been mispricing outlier risk, to a certain extent for a long time now, because I think that you can mitigate that with some really small tools, which means one of the reasons I love what we do is because I feel like everybody should do it. But the reason everybody didn't do it was because of all these risks that they thought were out there that I don't think are real risks. And the question is now, in 2023, seeing what we've seen over the last couple of years from the pandemic to what's happening right now in the Middle East is, can we officially put unquantifiable risk out of the equation so that we can really convince everybody, hey, you know what?
Asymmetrical risk is a non-issue.
If you stay small and manage early. Yeah, there's two ways to eliminate virtually 99.9% of all asymmetrical risk. Now, does that mean you eliminate risk? And the answer is, of course not. The bond market, which is an absolute perfect example this year of, in the last 12 months, has dropped almost 50% price-wise, principal. So I'm not suggesting for 1 second that there is not principal risk in the marketplace. There is. Lots of stocks have dropped 50%, 80%, whatever it is. There is absolutely principal risk. But is there risk of, like you blow out because you did something today and you're gone tomorrow? That's what
only
scares
if you buy 1 day to 0 days to expiration.
Well, forget that. Forget that. But just talking about in general. In general, like
that you get the fact of a gap lower open. That basically a gap lower on a holy war or on a pandemic.
Yeah,
is non-existent.
I'm not suggesting for a second that we can eliminate risk, eliminate principal risk. That's absolutely ridiculous. And no matter what we do as an investment, there's going to be a relationship between the amount of risk that you take and the amount of money that you can make. And if you can't establish that ratio, then you shouldn't make the trade. Like, in other words, you should never risk 50% principal. I mean, knowingly you wouldn't, but you should never put yourself in a position where you think you're risking 50% principal to make 20 or 25%, unless you have a 75% chance of success. But if it's 50-50, it has to be 50-50. And if you don't think it is, then you don't make that investment. But what really scares people is we don't want to put ourselves in a position where we wake up today and we don't wake up tomorrow. And that, I think, is the risk that has scared the living crap out of everybody, which is why there's such a small universe of people that actually trade for themselves. And I think that's what we can recognize now is going to change. That's what's going to be different.
Where people will be more comfortable in an actively managed environment because the theory of a black swan is irrelevant.
I believe so. And I believe that if there's nothing good that I at least at this point I can't think of anything good that's going to come out of the most recent conflict from last weekend. It's the whole thing is, like you said, it's a humanitarian crisis. It's a disaster on so many different levels, but it's also validation that, again, that the marketplace has become so damn efficient because of how much money and the current market structure and the different and the level of liquidity today as opposed to 20 or 30 years ago, that we can essentially absorb anything.
What does it say about the nature of the actual economy that even in the face of a pandemic, a global pandemic with the work from home and all the changes that entailed, or now this sort of whether it's the war in Ukraine, now the situation in the Middle East, all the implied destabilization of the security of shipping lanes and airports and whatever marginal sort of that the economy functions clearly, that the market's perception is that the economy can function irrespective of any of these variables.
I mean, you're asking, it's a great thing. It's a great sign.
Right, but what is this key to the economy that allows that?
Size. Eventually it got to be scale. It got to be size. That the players now are so minor and they're so insignificant, and that means all the psychos, whether it's Putin.
You're talking about world leaders or whoever.
Dictators, psychopaths, whatever they are, they've essentially been rendered, like the risk that somebody like, let's just say, like a Trump posed to the globe, the risk that a Putin posed to the globe, the risk that Kim Jong-un or somebody like that, their risk has been diminished greatly by just the pure size of the market. They've been swallowed up by it. They're insignificant players now.
But still, that is. So, but at the same time, the perception. So I mean, because the market's. Let's just call it what it is. The market's perception is, as long as there's a jobs market, nothing else matters.
Yeah, as long as
there's inflation, could be worrisome, but even inflation is not that bad as long as there's a good jobs market.
Yeah.
That the housing market could be worrisome, but that whatever's going on with the housing market will be fine as long as there's a jobs market.
And we can only tolerate a certain level of like fraud, like the whole FTX thing. We can only tolerate a certain level of pure fraud, pure evil. But for generally speaking, it's within certain boundaries. There's an acceptable number now that the market can absorb. Just like any other business, you can absorb a certain amount of inefficiencies. And
is the collapse of FTX? I'll ask it a different way. Why do you think the U.S. dollar is doing so well? And is the crypto winter dollar positive, or is the dollar positivity more a function of the move in the bond market over the last year, obviously, and all these other?
I mean, I'm not gonna suggest that digital assets have had really any impact at all on the dollar. I think the strength of the U.S. dollar is just that the U.S. economy is so dominant. I can't think of it as anything but just the dominance of U.S. economy, U.S. pool of liquidity, and the other thing, globally speaking, the central banks around the rest of the world. I mean, like we rail on our own Fed because because they're not proactive, they're reactive. They're not in front of anything, in my opinion, and a lot of times, I just don't see them as being that valuable a resource. But when we look at the rest of the globe and we look at the central banks, everywhere, they're worse. They're way worse, and on so many different levels. And there's so much disorganization, there's so much dysfunction, globally among central bankers and all over the world. It's a worse. So whatever our situation is, theirs is worse.
How is this market for you as a trader?
It's not bad.
Why? What are the good parts of it right now?
Well, the good part is listen, we're sensitive to volatility, and volatility is at its averages, wrapped around its mean. It's maybe a little bit higher. As of today, it's pretty much right there, 17 and a half, 18 in that range. It's pretty much a long-term mean. It's anytime you're at your kind of like the perfect, it's almost like, it's like 70, it's like we're playing a sport at 72 degrees.
Goldilocks.
When volatility is wrapped around its mean, you're essentially in its perfect weather. Mm-hmm. That's what it is. It's not too hot, not too cold. it's if you could have this every day, you take it.
Where do you see the most? Where is it? Where is that the most true? In other words, is there a difference between oil and the bond as compared to the equity indexes or even individual equity?
Yeah, sure. There's a difference. There is clearly, the commodity markets, they're not in turmoil at all, but they've absorbed this stuff. Like you just mentioned oil. Like oil has absorbed, it opened up $3 or $4 the other night on Sunday night on the whole invasion on Sunday, and then it's worked its way right back down to it's $1 higher than where it was on Friday afternoon right now. So it's taken 3 days to normalize. That was Sunday night. It's Wednesday. It's taken 3 days to normalize. These markets are just they are not going to let a little emotion or a little volatility come in, take over from what is this incredible depth of liquidity.
Does that ultimately spell the end of trading as the market becomes more efficient and emotional distortions become shorter, smaller, and tighten more quickly? Does it actually reduce the field of opportunity from a trading perspective?
Well, there's a couple different ways to look at it. On the one hand, somebody would say yes, because dysfunction and disorder is synonymous with opportunity. That's person A. Person B would say, well, that's true. So there's less, everything's more efficient, but the other side to efficiency is there's less theoretical give up. There's less give up to theoretical. So what happens is that instead of paying 10% to play, you're paying a half of 1% to play. So you're essentially 25 times more efficient, 20 to 25 times more efficient price-wise. So which would you rather have?
So you have a less distorted price, but you have a price, because the price is much more accurate reflection of reality, the probability of overpaying also collapses.
If you're a tasty trader, you would much prefer efficiency because you understand that the worst thing is edge to the house. So the best thing for you is the smallest amount of give up to theoretical. If you're not a tasty trader, you're looking for extremes, and because you're playing it directionally, which is 100 times more difficult, but your extremes are going to be less, but you're in those cases your give up to theoretical is going to be more.
The same way that the market has looked through the pandemic in a month and change, looked through the recent events in the Middle East, which are beyond, visually and mentally horrifying, 12 hours.
Yeah.
Does that mean that the perceived political risk for the American election next year is actually probably not nearly what people are they're like, oh, next year Twitter's going to be covered with lies, and
I do agree with that. That's a really good lead, but I agree with that. I think that's kind of what I was just saying before, but yes, I do believe that where we were sitting back thinking that 2024 is going to be this incredibly toxic year politically because of all the garbage, that I do think it's going to be greatly diminished. I think the people that, given the nature and the people that are currently, in the lead to have the nominations, they're pretty much, they're dead. They're non-players. They're old. They're stupid. They're just non-players. They're not effective leaders. So they will be rendered basically useless. It doesn't matter. There is no on the ballots right now. There is no effective choice.
But the point is the market's normalized that.
But the markets will eat that up because they don't have to deal with it. Then they don't have anything to worry about. There's nothing to worry about. That's the cleanest. That's the best thing in the world for the markets.
Will we return to the futurism, sort of soup the hyper optimism? We haven't heard much from AI in a minute. We haven't heard much from Web3 in a couple minutes. We haven't. And to me, that leapfrog, and it's not just the tech companies, but it's the deployment of the tech inside of finance companies and inside of fashion companies, and never ends. do you believe that what's underneath that is intact, and will that return to the front of the marketplace?
No, I don't believe it's intact, and I don't believe it will return to the front of the marketplace.
You don't believe what's intact?
I don't believe that last year's, like that's almost like asking me, how big an impact do you think 3D printing will have on 2024 election?
Sure.
Like do I think that Web3 and decentralization are going to be talked about, and cryptocurrencies to a certain extent? The answer is no. I do think there's a binary opportunity there, but that's a different discussion for a different day. Do I think that we're going to be getting into like 2024 is going to be the year of AI and everything else? And the answer is no, I don't. Now, if you're asking me what is, I don't know the answer, but it's not going to be.
But the point is, we're moving through all of this.
We move fast now.
Like process. Okay, fine.
Yeah, that's yesterday's news. Yeah.
And then is the market then pricing Fed cuts sooner, later, earlier, rate of inflation, like all that macro? Is that the relevant piece here?
I think that the demise, that the crash of the bond market and interest rates going to
8% mortgages, 5% bank deposits.
I think bonds going to par for 7% yield, and things like that. I think we're a little ahead of ourselves right here. It's not going to be that easy. It's going to be much more. It's going to be very indirect. It's going to be choppy. It's going to be a nasty marketplace. And I do not think the bond market is going to lead the chart. The bond market kind of led the game in 2023. I do not see that happening in 2024. I think there'll be new leaders. And I think you're going to see a very different marketplace in 2024 than you saw in 2023.
But you have no idea what that would be, other than different than other than the fact that it will be different.
I've gotten good enough at this game now to know that I have no idea what it will be.
Other than to be confident that whatever the last music they were playing is, they won't play the same music.
And that's true. And on top of that, I also know that the election will be essentially, based on everything I can tell, the election will be a much less of a non-event than anybody thinks it will be, and the outlier risk looking forward into 2024 is going to be very different and or non-existent as well. So I think it's a really different marketplace.
But how would you even define outlier risk? That's what this would be like. I mean, because now I basically feel like you're left with aliens.
And
I feel like the market would be like, aliens.
I'm not sure aliens matter, but a nuclear attack.
And then nuclear. Those are the only. We've done pandemic.
Yeah.
We've now gone war in Europe. We've gone basically war with Russia.
Yeah, but if I had asked you before 2020, you would have never brought up pandemic.
Right.
Yeah.
Or if I told you that America will basically be in a hot war with Russia with a thin proxy in the Ukraine, and the world will be like, eh. Or if I told you about what was going to happen this weekend, and the response and the whole thing, and then the market says, eh.
Yeah, no, I can't. None of that.
So you're left with nukes and aliens.
Pretty much. And I don't even know.
And I don't know that nukes and aliens ultimately represent that much of a threat to the economy.
I don't know either. I'm not sure about aliens. I think nukes will be good, but whatever. The point here is that
then doesn't the market have to go higher?
Not necessarily. Because you can have a situation
where you have an orderly decline, like the bond market.
Exactly. That's the whole thing. Why did bonds, lose 50% of their principal? And that was that's what we call an orderly decline. Like, why can't you? Of course, you can have an orderly decline in stocks.
Which is different than outlier risk, because outlier risk is a gap lower or higher tomorrow.
Yeah,
and in our definition, you can still lose all your money or make a lot of money, but it's more likely to be done more likely now to be done in an orderly fashion than ever before.
That's right. People lost a lot of money in the bond market this year, but they also had an opportunity at any point to get out. Okay, people, it wasn't a weekend move. People, as long as there's an opportunity to do something, the thing that scares me, the market that scares me is like, commercial real estate market, for example. It scares me because even if the market is going to go lower, real estate scares me because even if the market goes lower, and even if it's a slow decline, you don't necessarily have a chance to get out if you want to, because it's such a slow process. It's so hard to. There's no liquidity.
So much friction in the transaction.
Yeah, there's so much friction. There's so much cost. There's no liquidity. All this other stuff. In the stock market, it's nothing. That's not how we work.
Right. It doesn't exist.
We don't roll that way. No. So in the bond market, it's the same thing. Anybody can get out anytime. Give me 15 minutes. I'm done.
Get you out of even the big thing. You can have a multi-billion-dollar position.
Pretty much.
And and you can be gone from the bond market in a half hour.
Pretty much. Yeah. So which brings us to, that's a very different definition of risk and everything else. And so
which brings you back to your original discounting of the reason not to engage. Well, which is the asymmetrical risk is much less relevant than you perceive it to be.
Yeah, I mean, we started off the conversation today by just saying like you take the worst of humanity, and you take the worst of humanity, and you try to find a reason to, you try to find a reason to sell something. You try to find a reason to be scared.
Even for oil to spiral higher, nothing.
Exactly. That's my point. It's just, and if you can't do that, then what's so news is interesting because it tells you, because it
contextualizes your life.
Yeah, right. Okay, that's fine. But it doesn't. There's no value to it with
financial
markets.
assets.
No,
yeah, it's remarkable.
No, I've been arguing that now for 13 years straight on Tasty.
But now it appears to be true. I mean, you're getting very good evidence to back yourself up.
That's right.
I mean, when you run news events like we've run and have markets like we've had.
Yeah.
I mean,
there's emotion, sure. People get very emotional, and there's a ton of emotion in markets, and that does impact price, and there's very short-term emotional plays and all this other kind of stuff, and that's very fair, and I think that's never going away. But the reality of it is, let's tell it like it is, and the news is what it's for your entertainment pleasure. Or not pleasure.
Right, or entertainment anxiety, or a personal anxiety machine.
Right, exactly.
Whatever it is, but it's not market relevant.
Right, it's not tradable.
Clearly.
Yeah. So that means if that's not tradable, then what is? Well, that's the other, $64 question. But anyway, I think.
But that was my question for you, and you were saying that basically you're sticking with with volatilities at or above average. Stick to your playbook of.
Yeah, I'm just saying if you eliminate outlier risk for most people, they're willing to do something that is not in their normal comfort zone. Mm-hmm. Like anybody will buy something because the risk is the cost of whatever you paid to buy something, but not everybody will do something that's strategic where the risk is unknown. Mm-hmm. If you can convince people that the risk is very similar, but the probability of success is greater, then all of a sudden you're going to introduce people to different games that they never knew existed before, and all of a sudden you've got interesting set of dynamics, which in the end make everything else more efficient anyway. Globally, mm-hmm. It works. It
becomes a self-reinforcing structure because having more participants makes that much more efficiency.
Yeah, exactly.
And that much better pricing, and that much.
Exactly.
The complete opposite of this is because news doesn't matter, because outlier risk has been priced in, all the more reason to simply have a passive index fund. Because
why?
Because the relevance of so-called tradable events or tradable information is diminishing. That there is that the probability of events that create price extremes is going down, and that markets that tend to trade more around more modulated or more self-regulated in a self-regulated way is going up. The theoretical risk comes in.
I will argue that the problem with that is that you are then just settling for whatever the passive returns, whatever the premium is for passive returns over risk-free rates. So the problem with that logic is that if risk-free rates right now are, let's just say 5%, Okay, risk-free rates are 5%, and passive returns are 8 or 9%, which is the risk, which is the extra 4% you make for the principal risk that you're taking. Let's say it's 10%. I'll make it simple. Risk-free rates are 5%. Passive returns are 10%. Okay, so that means that there's a certain amount of additional premium that you're going to get on your return for taking a certain amount of principal risk that you don't really know what it is, but that's how the marketplace has assessed it. Okay, is that a good trade?
You don't know because you don't know what your risk is.
I understand that, but what I'm saying is going from 5% to 10%, because that's a very reasonable number. That 10% number is going from 5% to 10%. With a principal risk that is essentially you don't know. It's unlimited. It could be 5%, it could be 10%, it could be 20%. It's probably not going to be over 50, but it's somewhere in there. Okay, so is an extra 5% worth it? See, I would argue that that's the worst investment you can make.
Where you're having theoretically as much as you're taking 5 to 50% incremental additional risk for an additional 5% in passive returns.
That's what I would argue all day long. I would argue for people that tell me that the passive return makes a lot of sense, just put it in index funds. I would tell you that, well, with risk-free rates at 5%, if you really believe that,
you're better off to take your 5% and have no principal risk.
Exactly.
And keep it at the bank.
Exactly. Because it makes absolutely no sense.
So does the fact that you get paid money to keep cash for the first time in a long time, I would very good for the active trading business.
I agree with the dynamics. It changed the dynamics. So the way
it makes the passive index fund less attractive.
100 times less attractive.
By a lot.
Yeah, because the passive return. Because interest rates
is not high enough to offset the unknown,
and it doesn't go up. It's not. They're not correlated in that sense. So the passive return might have been 10% last year, still 10% this year. It doesn't move. Sure. But the risk-free rate's 5%. It makes no sense.
Right.
So people that are saying, well, you should just put your money in index funds now. It's the dumbest thing I've ever heard.
Can't.
Yeah, it doesn't make any sense.
You're better off in cash at 5%.
Of course.
Than you are in stocks.
You're better off buying T-bill. It makes no sense. So the upside is. The reason that I like trading more is because it makes more sense now, because then you can dial up whatever you want. So if you say to yourself, okay, well, you know what, the 10% not interesting to me, but 20% is worth it. Okay, then you trade.
No, that makes total sense. I agree with that.
But that's the logic. But do you know how many people think that way? Zero. That thought process does not exist in this world.
I don't know. There's got to be some people that think that way.
You find me one. Send me.
I'll search one out.
Send me a TikTok video. Send me a video.
Somebody who looked at the risk-free rate as a compelling case to trade.
Find me one freaking person that's ever given that argument. I mean, I say it all the time, so maybe there's somebody out there that's
that's heard it,
parroting it. But that is the case. I've never heard anywhere else.
All right. Before we wrap this, I have to ask, because the trial's happening and we're all seeing this. Well, I guess I'll go two ways at this. One, did FTX and Sam Bankman-Fried kill crypto?
No. No.
And what is going on with Michael Lewis, which I know is a retread from last week, but
yeah, I wrote about it in the Sunday night.
And you wrote, and such a reputation, widely admired, widely read.
He got
to throw yourself right, not just to take a defensive position for Sam Bankman-Fried, but to do it in a coordinated way on the week of the trial with 60 Minutes. I mean, it's a motivated.
I honestly think that he got wooed. He fell in love with the lifestyle, living in in probably the spare bedroom of a $20 million condo in the Bahamas, taking all the private jets everywhere.
Why? Because he was in the mix with these people.
Yeah, he was in the mix. Girls,
on the
drugs,
plane, in the mix.
Money, drugs, women,
entourage,
planes, the whole thing.
All the things.
Buying politicians. The power,
supreme, the incredible power.
It is so hard to separate yourself, and you want so hard to believe that this is all real, even though it's freaking fantasy land. It's made up. It's all criminal, but you want to just so hard believe it, and they didn't flinch. These are really good. I mean, they're really. I shouldn't say really good. They're small time crooks, but they were good at. They had a good poker face. And
Meaning Sam and his crew.
well, whatever. I don't know. Yeah, Sam for sure.
Okay.
But he was out of his league.
But they were playing at a size that is stunning. That's why I mean,
I wrote it in my cherry bomb. There's the trading world in Chicago. Not one person at one firm for 1 second would believe him on anything. Everybody knew Terry Duffy said it the best, and I don't throw Terry a lot of compliments, but he's the CEO of the CME, which is an $85 billion. He said 30 minutes. I called him out. I said, "You're a total fraud." I mean, that's it. That's it. It wasn't that hard to see. Anybody could see it.
and yet Michael Lewis, who's one of the most celebrated journalists in,
But he doesn't understand the business.
That's bullshit.
Flash Boys was the biggest bunch of crap ever. It was one of the worst books ever.
But you don't have to understand the business.
Yes, you do.
To say that if I say I'm opening an account,
you have to understand traders. You have to understand.
No, you have to understand the difference between a customer account and an investment fund.
We can smell a con artist in this business a million miles
No,
away.
but I'm just saying you don't have to be that sophisticated. If I tell you I opened a bank,
Yeah.
and I've got $1 million or $1 billion in deposits at my bank, and then I tell you that's my money.
He was telling you he was running a hedge fund and a trader. He didn't fool anybody. Forget that. If he just said he was managing money, that might have been different, but he wasn't. He said, "I'm running a hedge fund. I'm a trader. I'm building an exchange." These guys just tore him a new asshole. Okay, forget it. He didn't fool anybody for 1 second.
And crypto doesn't die as a result.
No. The technology is way too strong. Thank you, Mr. Radigan.
Thank you. Thank you for coming out. I know you're in your recovery, your medical recovery
No,
moment.
I'm good. I feel good today.
All right. It's nice to see
It's been a great show today. Thank you so much for listening. This is Truth or Skepticism. I'm Tom Sosnoff. He's Dylan Radigan, and you're listening on Tasty Live. And thanks. We'll see you next week. Thanks, Dylan.
Thank you.